board of UR Energy. We're publicly traded on the New York American Exchange as well as on the TSX. We have one operation up and running in Wyoming. It's called Lost Creek. It's an in situ uranium mine. It's been in production for over 10 years now, and we're ramping production back up there. We've also recently announced that we'll be bringing Shirley Basin into production, and we're starting to build it out right now, moving drill rigs out, putting the first monitor well ring in. We expect to have it completed late 2025, early 26, going into production thereafter.
My name is Mark Chalmers. I'm President and CEO of Energy Fuels. We are also listed on the NYSE American and also the TSE. We are a critical mineral company centered around uranium. We have a long history producing uranium, and we bolted on rare earths and some other elements that contain radioactivity. We are going into production right now. We have 3 mines that are ramping up their production, 3 underground mines. We're getting our in situ recovery project in Wyoming ready to go back into production, and are building up our ability to produce uranium right now, not in the future with low capital costs. But we're also commissioning our phase 1 separation plant, which is world significant, and are also in the process of acquiring a number of sources of rare earths to feed that plant.
Gentlemen, thank you so much for joining us. We're going to talk today a lot about North American uranium, the market, and on the whole. Now, one of the things I say to companies a lot is, don't tell me, show me. Now, you guys are doing that. So what do you think's going on at the moment that perhaps you're seeing in the market, which perhaps which indicates to you that there's a lot of telling but not showing? I'm sort of looking across some of your peers, not a lot of action out there. What's it going to take to kind of get them moving, get the market moving, and generally kind of bring this sort of enthusiasm back into the uranium space? What do you think, John?
Matt, it's going to take time. We're finding right now that globally, not just in the U.S. and North America, but globally, when you talk to any uranium producer, everyone's facing challenges post-COVID with manpower, qualified manpower, not just in-house, but out-of-house with contractors on the technical side and with drillers, shortages of supplies. You know, in Kazakhstan, we're hearing of the shortage of sulfuric acid. Doesn't sound like that's going to be resolved in the short term. Here in the U.S., we're seeing shortages of electrical equipment, instrumentation, things of that nature that just really tend to start drawing out the time it takes to get into production. So these are not the issues that are specific to the U.S. We're seeing them virtually with every producer around the world. So I think it's going to take more time than was expected to bring uranium into the market, and that ultimately is going to affect the price going forward.
Yeah, no, I echo that with John. And producing uranium is hard. You know, anybody that thinks it's easy has not produced very much uranium, and for all the reasons that John has brought up. That's what I think we're changing gears now in the market, where people have just been talking about what they're going to do, and now we have to deliver. And as John says, it's hard for all of us. But it is going to be very interesting to see how everyone transitions who's going back into production because of inflation, in trying to meet timelines and to fulfill contracts that have been signed. So, yeah, I just say it's a new gear here. And, unfortunately, and it's not just in the uranium business, but in the mining business as a whole, it is hard to deliver projects on time, at capacity, and at costs where you're profitable. So, kind of bolt on and watch this transition. But again, I'm going to just say you're producing uranium is not easy.
Yeah. And I would just add to that, Mark, companies that have a long history of production, like Energy Fuels, like UR Energy, people that have the engineering staff, the geology staff that has gray hair, the management team, the executives that have the gray hair. We have fought these battles before many times. So it's not new to us, but it is challenging. But I think those companies with the most senior and experienced production teams are likely going to be the most successful going forward.
Right, they're going to be the most successful, but I think the thing that surprises me, and probably a lot of people who you guys have been saying this to for 4 years, is if the guys have been there and done it before are finding it hard, are struggling to kind of get all the pieces aligned, the guys that are talking about the theory of doing it are going to find it even harder. What's the knock-on effect of that? In an investor's perspective, what's the knock-on effect?
Yeah,
what do you reckon, Mark?
I think the knock-on is just these issues that we were talking about. Is that you've got to get your project built and constructed and operating. I mean, it's one thing to build a project; it's another thing to get it to operate and provide your product at quality specifications, to get it out of the ground. I mean, one of the key issues, and I've done ISR, I've done conventional, about 50-50 my entire career, but you've got to get this stuff out of the ground. You've got to get it solubilized. You've got to capture it. And the same thing goes for the conventional mines. You've got to pull it out of the ground so you can process it. So I think where people try to simplify it is each of those steps are critical to getting to a finished product to market. Each step. And if you miss one, you can't miss one. If you miss one, you don't get that product to market on time, on schedule, and at product specification.
Right. And if I look at the gold market last year, there are a few companies that said, we're going to get into production. First pour happened, and people go, that's it. We are golden. We are in the money, and we've achieved everything we needed to achieve. And then the issues started. They couldn't get into economic production. There's a thing that miners sometimes forget about: economic production. And for uranium, it's got a whole bunch of additional complications in terms of not just the kind of geopolitical ramifications, which we'll talk about in a second, but in terms of the way this product needs to be stored, processed, enriched, etc. It's complicated. I mean, I'm particularly excited as an investor because I think the more of these companies that just don't get into production, the better it is for the ones that can. What do you reckon, Sean?
Yeah, no, you've touched on a really important point. Just starting flow or starting to see head grade, those are great signs, but there's a long ways to go. It's a marathon. And so just having first pour, that first drum of yellow cake, yeah, it's a milestone. It's important, but you have to reach economies of scale. And people that have watched my presentations over the years know the emphasis I put on economies of scale. You can't just produce 1 or 2, 300,000 pounds and expect them to be economic. There's so many fixed costs in the nuclear space because of all the regulatory oversight, the environmental monitoring, insurance, claim staking, all of those things. Those are costs that you have, whether you produce 100,000 pounds a year or 1 million pounds a year. Most uranium miners in situ anyway, they're not going to reach those economies of scale till they are producing a minimum of 400, 500,000 pounds a year. 6, 7, 800,000 pounds a year is even better. But we've charted this, and man, there is a strong linear relationship between those economies of scale and cost. And so a company can't just do the first pour or the first drum of yellow cake. They have to be able to demonstrate that they can continue to ramp up to those economies of scale. And some will, some won't. And as Mark indicated, we're kind of beginning to move into those stages where we're going to see who can and who can't reach those economies of scale and be profitable.
Well, margin is everything, Mark, isn't it? And I think you've been sort of highlighting or certainly signaling to the market with regards to the White Mesa Mill that just because you got pounds in the ground doesn't mean you're actually going to be economic. And I think a lot of investors fail to factor in the kind of processing costs, and maybe a case of, what's left after, say, because you've talked about, buying schedules. We've talked about tolling. We've talked about all sorts of solutions out there. But the margin for all businesses, and miners are not immune to this, is critical. So what do you say to investors perhaps looking at some of these smaller North American projects?
Well, again, echoing what John said, you have a certain amount of fixed costs, and those are fixed costs whether you produce 1 pound of uranium or 1 million pounds of uranium. So you've got to get those increments up to a level that they spread those down to where they're reasonable. Things like recovery. When you look at like even ISR, you've got these decline curves, and so you've got to go ahead and get those head grades up, and you got to perpetuate those head grades to make sure that you get the recovery of the pattern that you have. That's been a challenge. Some projects will come up really, really strong on the head grade, and it doesn't perpetuate. So, we've got a number of projects that are, being advanced that don't have a lot of history, and all those things are critical. And I've seen, projects with the decline curve and all that. And again, it's the same thing with conventional. You've got to have the grades, you got to have the recoveries, and all those things are intertwined. So it's complicated just to capture in one or two words, but I think you got to get the economies of scale. You've got to look at all aspects from, is the resource there? What's the grade? What's the recovery? Conventional ISR, decline curves. All those things are important, and it is easy. It is easy to sit there and produce a drum of yellowcake or 10 drums of yellowcake. But when you start to talk about 500 million pounds, 2 million pounds, it's hard to kind of fake that. It's hard to fake that.
Right. And so talk to me about the cost of money, right? Because we've seen some reasonably high profile, I'm not going to be so crass as to name names, but obviously they're getting a bit of abuse at the moment for a convertible note that they've put out there. And the cost of that money is concerning people, as it always should have done. But this one in particular just has stood out as getting all sorts of commentary from people like Rick Rule and others say the management team has not done a good job of explaining why would you do a convertible note which has some kind of coupon attached at 9%, coupon attached to it, payable in mixture of cash and equity, but nevertheless, and plus 3% kind of setup fee for it as well, which is not unusual for convertibles, but in this instance, people don't get it. The cost of that money cannot be fixed by waiting for price, accretive price growth in uranium alone. There must be a plan in place to deal with that one. So when you guys have been, and John, I'll start with you. When you guys have been raising money during your kind of development phase, what have you been conscious of in terms of that kind of cost of money equation?
Yeah, we're not looking to do any raises right now. We're well financed. Into the quarter, we had around $53 million, no debt. So we're not out testing the market on the financial side to see where things stand. But despite that, we are constantly getting inbounds from bankers, letting us know, hey, we can do this for that. And we're like, okay, we're not interested right now. But right now, I think the terms are no warrant. If you're a legitimate producer with a history of production, a known entity, the financing costs are going to be remarkably less than if you're a bit of an unknown entity trying to prove yourself. Now, to be clear, some of those unknown entities that have not produced before, some of them are going to successfully get into production, but some aren't. But because of that risk, the terms are not great. But no, from our perspective at UR Energy, we've always done a really good job at minimizing dilution to our shareholders. There's been some dilution, but we've been successful at minimizing that. And we do that through revenues. We've had great revenues over the years from long-term contracts, and that's the philosophy we're going to continue to take is we'll use those revenues to offset those needs. And we'll leave a little bit of blue sky for production as part of our hedge strategy. But no, the money is certainly available. The market is hot. And I put together a list of probably 20 banks the other day for my board and said, hey, these are the banks that we have relationships with. Not all of them would be our primary bankers, but we get these inbounds constantly. So I think if you're a proven producer, and you've got a reputation of being able to meet your contracts and locking in good revenues, the risk to the banks goes down remarkably, and the financing is readily available at reasonable terms.
Well, absolutely. And I think Explorers, it is your job to raise money, drill, and grow the company. As in the development phase, I think it gets quite interesting in terms of the type of the money and the cost of the money and the allocation of that money. It is important. So here what you're saying about dilution, Mark. But we've always talked in the past about, look, sometimes you got to take the money when it's there, but you got to do it with purpose. So what's your attitude to cost of capital?
Yeah, well, again, we're well funded. All of our activities for the uranium mining are funded right now. We don't have any debt, zero debt. But yeah, when I look back in hindsight, and UR and Energy Fuels are both blessed with the fact that we have projects that are fully paid for, debt-free, and or close to debt-free, in our case, debt-free. But I think people underestimate that cost of capital because a lot of these newer projects are going to require, $500 billion, $1.5 billion. And again, they've got to hedge those costs, for the debt equity, how they raise that money. I worked, I'm not going to mention who they were, but I worked for a company about 10 years ago, and we were paying like $10 a pound for interest alone, not including the principal recovery, okay? And you start adding that on top of your operating costs, on top of your overhead costs and everything, and a pound gets expensive really quickly. So I think there's really two kinds of producers: those that have already built a lot of their infrastructure out, they're either debt-free or largely debt-free, and they have the ability to strike right now with be able to move right now, to produce right now, and have limited, particularly debt exposure. And then you look at some of the newer projects that are going to require complete new capital and financing and all that. So they're not comparing apples to apples in all cases when it comes to new uranium production. And you also, to get that debt financing, you're going to need a lot of contracts at high prices to get that debt in place. So again, it's not easy, and you got to look at apples to apples, and you can't necessarily be apples to apples when you look at projects that are new, projects that require significant debt financing and equity. But in our cases, both our companies are well positioned with limited, capital requirements in terms of new capital in the scheme of things compared to others.
Absolutely, and I think the thing that scares me slightly is when I look at some of these, up and coming sort of capex projects, $1 billion, $1.5 billion, and I think in reality probably even a couple of billion bucks to get that in place. You need a lot of things to be working in your favor in terms of the market. So ex-banker, I'd be looking to permitting, number one, which makes me slightly nervous about some of the Canadian projects in terms of that timing. So for companies to kind of, I guess, keep the momentum going without having permits is going to be an interesting one. And, time is money. So I'm intrigued to see how all of that plays out. But likewise, if I'm trying to kind of work my way through to some kind of revenue position, I've also got to be certain about the ability, even if the company can build this, to be able to get into business, as it were, in terms of those kind of social components. And I know both of you spent a fair bit of time making sure you kind of got social license to do business. John, for you, is that, how important was that?
Oh yeah, no, it's absolutely critical. We're fortunate to work in Wyoming exclusively, which is a very mining friendly state. In fact, in 2014, the state of Wyoming helped fund the ramp up of our Lost Creek project through a loan, which we've paid off. So it's a great state to work. But that doesn't mean you can rest on your laurels and not pay attention to those things. You have to operate your mines in a manner that's environmentally responsible. You have to maintain compliance, and you have to reach out to those communities and talk to them. You talk with your neighbors, let them know what you're doing. If you don't do that, you don't have your social license, and life can get very difficult very quickly. And as you've indicated, that's a key component. I don't care where you work in the world. It's a key component to being a financeable story, is having the support of your local communities and governments, to be able to do that. So any company that doesn't dedicate time and energy to do that, maintain those relationships, they're setting themselves up for failure. And I would add too that if a company is looking to minimize dilution, they don't want to do an equity raise, but they have a large build out ahead of them, before they can go to a bank or get funding through some type of a loan, whether that be convertible or not, you have to have a demonstration of contracts. No one's going to give you a loan when you've got no line of sight on revenue. So you've got to get those contracts in place. So having that marketing strategy at the right time, you have to convince the utilities that you are a good risk by geographic diversity, by diversity of the project, that you've got the right team to be able to get into production. So if you can't convince the utilities of all of those things, including social license, you won't get the contract, no loan. So it's a bit of a chicken and egg issue that new miners have to work their way through to be able to get that financing if they want to stay away from the equity raises.
Well, yeah, and I think also, I guess the point I was working towards is the fact that once you've got this thing, say you got your plant financed and built, and then whatever social issues come up and you can't actually deliver against what you promised your debt providers, it becomes quite painful. So literally, time is money. I'll keep saying it again because people kind of forget that is a big deal. It's happened in Alberta, up in Canada. Has happened in multiple jurisdictions around the world. So that's a tough thing. I mean, Mark, for you, obviously, your infrastructure is built. You've got the White Mesa mill there ready to go, and you're trying to prime it up with not just uranium, vanadium, but also rare earths. You feel comfortable about your ability to do business?
Yeah, well, I'd hope so after 48 years of being in this business. And yeah, again, falling on it. And John and I are very like-minded in how we kind of look at the world in terms of uranium production, the regulatory risk and relationships. One thing you have to do is you've got to demonstrate to your regulators that you're responsible and you go through a process. And there's regulatory creep going on out there everywhere in all states because everybody's scrutinizing projects more extensively than they used to. But having good relationships with your regulators is absolutely critical because if you lose your regulator, you're in trouble. And I don't care what state you're operating in, it is a challenge. So if that happens, now we've always had good relationships with our regulators, and we plan to continue because we work with them in a very professional way at the highest standards possible. But on the kind of the social front, the ESG front, we have done more over the last 2 or 3 years than we've ever done on the ESG front. We set up a foundation. We committed, we put $1 million into that foundation, and we committed 1% of the revenues from the White Mesa Mill going forward. We have made a number of contributions through the foundation that is really getting traction. We have 2 Indigenous advisory board members. And they give us some really great insight into where we should make contributions and whatnot. But it is political, and where we operate is more sensitive than Wyoming, and in a lot of cases, like in southern Utah, northern Arizona, even in New Mexico, even in Colorado. We have one project that's right on the border of Utah, Colorado. So not all jurisdictions are created equal. We also have significant operations in Wyoming, but it's a different world that we live in today, and you've got to pay more attention to it. You got to be more proactive, and you have to do more communication with your various stakeholders, whoever they are.
Right. So you talk about geopolitics there, and that's the thing that always fascinated me about this space. And of recent days, we've obviously had the Russian ban on in terms of the enrichment and services from Russia, and I think that's made everyone super excited because it means that once again product flow and supply into the market has tightened. Knock-on effect for that, should be higher prices, which for investors super exciting. But there's the talk of waivers, potential waivers in there. Do you know much about the terms of what has been announced, John?
So on the waivers front, I've been able to participate in a meeting with the Department of Energy on that. And right now, guidance is being set up. Certainly, the utilities are weighing in on what they believe they need for waivers. The administration obviously will have a lot of say in what that looks like. But as of this day, nothing has been announced on what the structure of waivers will look like. But once the president signs the bill into law, the ban will take place 90 days after that, and it'll last through 2040. The waiver process is fairly short-lived. It only goes through 2027. After that, there will be no opportunity for waivers. So, the one shoe was dropped. I think it's very likely President Biden will sign off on this in the coming days. And the second shoe to drop will be, how does Russia respond? And I think that's going to be really important. Are they going to cut off that supply immediately, or will they participate in the waiver process or not? Our internal speculation, our internal analysis is that they will cut it off, because the contracts, the commercial contracts that they have right now, we believe are likely underwater compared to where the market is right now. So why would they continue to deliver into very low-priced contracts when they could turn around and sell that material to China or others globally? If they do that, which again is our expectation, that puts more pressure on the market. That means Western refiners, conversion and enrichment in particular, they have to step up the game even more quickly. They may be doing more overfeeding, using more uranium to be able to meet that demand going forward. That in turn requires more uranium, which puts more pressure on the uranium price. So that's our expectation in the coming months, but we'll see how that second shoe drops. And then the third one will be, is there any contagion? Does Russia try to push this geopolitical issue further into the former Soviet satellite states? I'm not a geopolitician, but that is definitely something that's on our minds, is how does this expand?
But where does it get picked up? We talked many times, Mark, about ConverDyn in terms of where they are today and where they need to be, and the US is talking about $2.7 billion worth of funding to expand domestic uranium conversion, enrichment, and fuel fabrication, but it's going to take time. So is this the right move for the US for now? And can we pick up the slack?
Time is the question. Money. You can only throw so much money at these things, and it doesn't necessarily speed up the time factor. It takes time, and that is that is going to be the delicate balance here. Is trying to keep reactors running, making sure we have fuel, and turning off or turning down the faucet, to get to a sustainable outcome. I think and I use this term. The world became addicted to cheap, okay, and there was this focus on globalization, and that it was okay to go where it was cheap. It was okay to go to Russia. It was okay for them to take the nuclear fuel cycle. It was okay to go to China on critical materials. COVID kind of changed the way people think about critical materials, but it was really the Western world that kind of set this up, because people just said, I want to go cheap. And so now we're having to kind of pull that all back. We spent, 20 years getting the infrastructure in place in the United States to be independent with our own nuclear fuel cycle and other industries, not just nuclear fuel cycle. And we let it go. So, it will be very interesting. I mean, I think the bipartisan support that we're seeing, the realization that we're seeing that we overdid it, but now to bring it back and all these different sectors, it's a big ask, and 3, 4, 5 years is not a lot of time.
It's not a lot of time, but I'm still trying to work out how the U.S. fills its boots in a moment like this, when right at the outset of this conversation, it said, look, not everyone who says they're going to get into production will get into production when they say. And I think there's probably a case for not everyone who thinks they're going to, or tells us they're going to get into production, will get into production, right? So how does the money need to flow? So government is perhaps looking downstream in terms of enrichment, etc. But not you two, but most equities, uranium equities, are struggling for affordable cash to do what they need to do. Developers are looking around and trying to work out how they reduce that cost of capital. Utilities have been playing their cards very, very close to their chest in terms of where they've been getting their inventory from in the past, how much their term contracts are actually being signed for, and indeed what their plans are around the current inventory levels and when they're going to restock. So do you see any instance where utilities start to pave like OEMs are, car manufacturers, and going upstream into lithium, going upstream into copper and nickel projects? Is that ever going to happen in the uranium space? John, what do you reckon?
Yeah, so many years ago, the utilities did have a little foray into uranium mining and other fuel fabrication development, things like that. They quickly learned that was not their expertise, is not where they wanted to be, so they immediately stepped out. Major oil and gas companies did a similar move back in the 70s, realized it was not the space they wanted to be, and then they stepped back out. Companies like Mobil, Texas Gulf, Conoco, and others, Kerr-McGee, but none of them are in the space anymore. So I think the lessons were learned back then that they need to stick to their knitting, stick with where their expertise is. So do I see them jumping back into these spaces, whether it be uranium or other transition metals to assist with going more green? I really don't see that happening in the foreseeable future. I think they're going to stick to electron generation.
Yeah, tough lessons learned for a lot of people that decided that uranium was flavor of the decade and got back in. I don't know. I think, though, that some utilities might align with certain producers in a different way without kind of getting back into physical production. I think that some of the nuclear utilities may, try to have closer alignments without getting into physical production, but it's too early to tell right now. I think it really depends. I mean, the worst case scenario here is we, as producers in the nuclear fuel cycle, we don't want to starve reactors. We don't want to starve the nuclear renaissance. We want to keep enough product coming so that the nuclear renaissance can continue on. And but it is a little too early to tell. But I can tell you this: it's a little scary, from my perspective, because all these dynamics are all kind of happening at the same time. I mean, if you go back to in like the 70s in the United States, there were 25,000 people working in the nuclear fuel cycle in the United States of America. And I'm just talking it wasn't the whole nuclear fuel cycle. It was just the uranium production cycle. 25,000 people and producing around 40 to 45 million pounds per year, which is a lot of uranium, but that's a lot of people. And so, I think the key thing here is making sure we keep a sustainable nuclear fuel cycle alive and well, and for people to deliver and make sure that we don't end up with some sort of a hiccup and be able to provide the products required for that to happen.
Yeah, we did really begin to see better alignment with utilities and U.S. production. I think as early as late 22. We started to hear from U.S. utilities, hey, we need more diversification. They explicitly told us that, and we want U.S. production. We're willing to support U.S. production much more than we have in the past. And so some of our early contracts that we were able to sign, the utilities said, hey, we need you guys. We want you guys into production. We are specifically targeting U.S. producers with our contract book. And so we're beginning to see that better alignment for reasons of diversification. So that's going to help grow the U.S. industry, and not just the U.S. industry, but moving away from Eastern production, moving away from Western Bloc production, moving to Canada, the U.S., some African countries. Ultimately, probably by 2028, 2029, we expect to see most Kazakh and Uzbek production will likely be going east, not west. So we've got to ramp up Western production. It is absolutely essential that we do that.
I want to bring up a flash in the past. UR Energy and Energy Fuels filed a Section 232 again with the Department of Commerce. What was that, John? 5-6 years ago or something? And we took a lot of heat globally on why would you even think of such a thing? Why would you even bring up our dependency on nuclear fuel products, to the United States of America? And actually, if you look in hindsight, that was really a very forward-thinking. And if we had gotten relief under the Section 232 a number of years ago, just think of what a better position the United States would be right now regarding dependency on some of these other countries. And so it's not that it hasn't been discussed, communicated over time, but, we are where we are. And but, our two companies were the front runners in the world when it comes to, raising the flag and saying, folks, we're in trouble or could be in trouble. And the only thing that we missed, in my opinion, is it's been worse than we anticipated. We were not expecting, the Russia invading Ukraine, and it's been worse. The geopolitical tensions, in my opinion, are worse than when we filed the Section 232. But the outcomes are the same. That we're in a pickle here, and we're trying to get out of the pickle.
Yeah, I mean, obviously, I think the cost of energy has been, horrific for most. Not just homes around the world, families around the world, but also industry. It impacted Germany greatly. I hear what you're saying. You guys kind of led from the front on that one, and there's a few global moves, including the printing of money for fun, which really kind of helped the story here. But coming back to the investor's perspective, okay, and we saw it, people kind of like to refer back to the previous cycle, the 2000, pre-2011, Fukushima, etc., and try and draw parallels. But I'm not, and I kind of want to in a way, in the sense that I'm trying to work out pre-2011, pre-Fukushima, what were the drivers for shareholders in terms of that kind of leverage versus de-risked investment for your portfolio, and where should I be looking now? Because we've been operating in this kind of vacuum where lots of companies, developers have been able to talk and get a free pass of talking a good game without ever having to fess up, without having to actually prove anything. It's all theoretical, and that's a very nice place to play. But now it feels like the rubber's hit the road, Mark. Where do I deploy my capital? What does my portfolio look like? Where am I going to see the best returns?
Well, I'm not going to pick winners or losers, and I have to be careful, obviously, for thinking and looking. And it's a tough one. I mean, I think when you look at the this uranium boom, and it's a boom. There's been significant appreciation in people's shares. And at the same time, like you said, the rubber hasn't met the road yet. And some of these events, when it comes to the Russian ban, shortages and everything, I mean, the price of uranium can keep going up and up and up. And I think a lot of these equities will go up with the price of uranium. But not everything continues to go up forever. And look what you saw in the lithium business, went up and up and up and then went down. Now, I think the nuclear fuel cycle probably looks better today than any time in my career, going back through about 3 booms now. So I think, we're those that are in the space are in a great position looking forward. But when it comes to, those that just talk and never do, I mean, I don't know what advice to give other than I think, I'd caution people, just because the share price has gone up the most doesn't mean that's the best long-term play. I mean, that's the only thing I would say. Just be careful, because there is a lot of talking, and you have to support your market cap over time, like on an earnings per share basis. And, so if you don't deliver, that's not going to be sustainable.
Yeah, I just would second a lot of those comments. We believe the uranium price has got some room to run. There's still upward pressure on that. Certainly the fundamentals of the market will allow that to continue to go higher. Geopolitics, we believe, will continue to push it higher. Difficulties with wrapping up production globally will continue to contribute to that. So in a rising market, it's kind of hard to lose. You can pretty much invest in anybody and do really well. But to Mark's point, at some point, years from now, potentially, the market will plateau or even start to decline. And we don't expect to see that anywhere in the near future. But when that happens, you'd better be invested in companies that are well protected of demonstrated production. If you're invested in more of the exploration companies or companies that have not been able to get into production, their shares are probably going to tumble pretty hard. So I think diversification, I mean, I'm no financial advisor, but diversification and making sure you're getting in some of those value companies that have demonstrated production historically at profitable cost levels is critical if you want to be in the uranium space.
Right. Okay. I just feel there's a kind of lull at the moment, obviously, because spot has kind of fallen as sort of we're doing a bit of price discovery at the moment. What are we looking forward to in terms of that price discovery? Do you want some big catalyst moment like we've talked about in the last 4 years, Mark? And I think most of the people on Twitter /X like a sensational story every day of the week, but what's actually going to drive movement and momentum for equities in the market?
Well, I think improving uranium prices, number one. I mean, if the price goes up, and it's interesting, the price drops back to $90 and people get depressed. They say, it's only 90 and all that. And look, I think most producers need more than that to really be sustainable and get the right earnings per share. But I think that it all driven on the uranium price. I think that, over time, I think that when you look at the whole nuclear fuel cycle, you've got to see continued growth in nuclear power and more reactors being built, both large and small reactors. We've got to have, delivery. And historically, the nuclear fuel cycle with reactor construction have not have a really good history on building reactors, on budget, on time, and whatnot. So I think that the fundamentals of nuclear fuel cycle have got to show that nuclear is here to stay and growing and got new applications, got to be successfully delivered. So, it's from the uranium mining right on through the generating electrons with nuclear power. Long term, people have to see that nuclear is not stuck in the mud and it's going to continue to be successful in all those different steps. And again, it's not too dissimilar to producing a pound of uranium and getting it in a can and shipping it. You've got to show the nuclear fuel cycle is sustainable and growing over time right to electrons.
I would just throw in, to add on to that, the small modular reactors. Tremendous opportunity there to build out more reactors, put reactors in places where you wouldn't normally see a standard 1,100 megawatt reactor, but northern climates, islands, different places like that. That could be a tremendous source of growth of demand for uranium. So that vision is there. There are a number of companies working toward it, but we need government support, not financially on that end so much. We just need regulatory support to be able to give timely, good reviews of those and to advance those projects into fruition. And if we're able to do that here in the U.S. and globally, we're going to continue to see a dramatic expansion of carbon-free electric generation at a reasonable price and tremendous uranium demand associated with that. So we're big proponents of that, advocating for that. And we think that's one of the big topics that the U.S. really needs to focus on is to enhance the permitting and the regulatory oversight of those to advance it.
Right. Okay. And one sort of final one here. We saw, again, last cycle kind of conversation around M&A. We're seeing, again, we continue to see new entrants into the marketplace, picking up projects which have been staked and from these kind of prospect generators. For you, Mark, how does the U.S. actually deliver the pounds that it needs? Because these explorers are going to take a long time. The permitting for developers is going to take a long time. We need friends in all the right places. The African place, and where I know you've worked, they're being looked at by the Chinese now in terms of securing and moving quicker. Is the U.S. government going to enable either financiers or companies to access money to be able to kind of guarantee that supply into the U.S. going forward?
One thing I find is the U.S. government is very supportive of nuclear fuel cycle, very supportive of reducing dependency on these critical elements, whatever they are, not just uranium, and also been very active in encouraging mining around the globe. and in some cases, encouraging mining more outside of the United States in places like Australia and Africa, particularly as opposed to on public lands. So yeah, I think that it's a difficult question, Matt, in terms of what the government is going to do and how they support it. I mean, I think the government needs to be more proactive. I mean, they've been very good at the back end of the cycle, but I need to be proactive from right on to the public lands. I think one of the real challenges right now is back to finding pounds that you mine, is replacing exploration pounds, because exploration dollars dried up for 10 years. And if you look at how much uranium was produced and nobody replacing, or very few pounds replaced, it's you got to get back to exploring for pounds, replacing those pounds, being able to permit those pounds, access right on through again. So I think the biggest challenge for the industry going forward is sustainability from the very beginning, including the small explorers, so there's enough of a market to incentivize exploration, because a lot of the easy pounds were found over the last 60 years. And the harder pounds are yet to be explored. We know they're out there. We just don't know exactly where they're out there. So I think there's a combination of government support, support for mining in the United States on public lands, not putting monuments over the top of some of our most prospective areas, and also going back and exploring for pounds and replacing the pounds. You need a couple 100 million pounds, discovered every year going forward. And they need to be quality, low-cost pounds, or as low cost as they can be.
Yeah. Okay. Well, a lot of investment, a lot of money needed. I think some exciting things going on in the space at the moment for sure. And I think expectation. And if we talk about the company that's done the convertible recently, that it's clear that they expect uranium to be at $150 to $200 just for them to stand still. So it's super, super interesting. And with such a tight space, perhaps they are right. Perhaps that's where this thing is going. We shall see. John, can you give us 2 minutes on why people should be investing in your company, and then Mark, perhaps you could follow up and do the same thing in a second.
Yeah, absolutely. I think primarily we are a proven producer, and it's such a small industry. I mean, literally, you can count pretty much all the producers on 2 hands. Globally, and we count ourselves amongst those. We've been in production for over 10 years, so we are a known entity, a proven producer, and a low-cost producer using in-situ technology in a great jurisdiction. So when people are out there looking to invest and they want a good value play that they can rely on, that is UR Energy. We're going to move heaven and earth to ramp production up to fill those contracts. About 50% of our current license capacity is under contract. We still have a lot of room to contract out, a lot of blue sky. And of that initial 50% that is contracted, a pretty good chunk of that is spot price related. So as we ramp up Lost Creek, we're excited to be doing that. We're staffed, got our rigs. We're moving now towards Shirley Basin to build out our second operation, getting it built out. That's moving along quite well, very nice. That's also a very nice project, very good grade, shallow. We believe it will also be a very low-cost producer here in Wyoming. But really would like to just point out history. That's why you invest in UR Energy, proven producer. We really believe we can do it again, and we will do it again.
Well, for Energy Fuels, a lot of the same things that John mentioned. I think, proven production, we produced like 30% of the uranium produced in the United States over the last 15 years or so, second only to Cameco's assets. UR was not in production 15 years ago, so I want to make sure that people understand that. Look at our balance sheet. Our market cap's about $1 billion, $250 million in the bank. We've been profitable, and we're building out this diversified, centered around uranium, critical mineral hub. Now, that's different than others, because most times you invest in just a pure play uranium or pure play rare earth play. we've been held back by some investor because they just want us to be pure play uranium, and we recognize that. Well, the reason we have been focused on a critical mineral hub is diversification, and we believe the margins on the critical mineral hub are equal or greater than the uranium business. That's the only reason we've done it. And so, but look at our company as a whole. Look at some of the acquisitions we've made just recently, or in the process of making, with Base Resources, and we have to close it. In Madagascar, in Kenya, and in the Astron in Australia. They all contain uranium, and they are diversification with our abilities to recover the uranium at the White Mesa Mill. So I think that that's what people need to look at over the long haul. We're not a short haul stock. If you're looking for the fastest appreciating share price over the next 6 weeks or month or 2 months or 6 months, we're building a long-term, profitable, sustainable world material and time company.